this question of, do you need risk management? Okay, I think that's something that a lot of traders perhaps, again, it's been sort of almost sledgehammered into traders that you need risk management to be successful, to which I'd answer, it's not necessarily true. And I say that because I've come from the prop background where we weren't taught risk management. What we were taught was, if you lose more than $600 today, I'm going to kick your ass. Okay, I don't want you to lose more than $600 because it's my money.
This episode of the Speculators Podcast is sponsored by Jigsaw Trading. Jigsaw Trading is an industry leader when it comes to order flow tools, training, and equipping traders to make better trade decisions. And if you've ever been trading and just feel a little lost and feel like you're missing something, and maybe you've been drawn to order flow and intuitively you know that it's important and that you should be learning this, but it's just a little overwhelming because of how it moves and because of the numbers and you don't really know where to start, I get it, but you need to check out Jigsaw Trading. On a personal level, my first exposure into order flow and the idea that this is important came directly from Peter Davies, the founder of Jigsaw Trading. And even through to today, most of what I do with order flow and my thoughts around it came directly from Jigsaw. We're gonna have more to say about Jigsaw later in the episode, and I'm gonna give you some direction on how you can access free order flow training starting as soon as today. But for now, let's get started with today's episode. I'm very glad that you're here. I hope you get something from today's conversation, and a big thank you to Jigsaw for sponsoring the episode. Let's begin.
I'm very excited to have you back on. It's obviously been a while since our last conversation. So what's been going on in life? Anything news and noteworthy going on? Any new kids, new pets, divorces, marriages, anything going on?
Nothing that crazy. For my birthday, my wife got me a 21-kilometer swim. So I've got an ocean swim of 21K in 7 weeks. So yeah, just ramping up the training for that. And for anyone that's ever done any kind of endurance sport, there's a lot of similarities you can draw upon trading and endurance sports. You almost have to approach them in the same sort of way, very methodical, very process driven, step for step, learn through iteration, learn through experience, and then you get to race day and you execute it well and hopefully you come out on top. So yeah, that's in the pipeline for the end of May. It's going to be a very interesting experience. I think
now, as far as your experience with doing performance sports, this 21K, is this the hardest thing you've done, or have you conquered similar things?
No, I've done 4 Ironman races. So I've done long course Ironman, which again, if you look at the sort of the time for an Ironman around 11, 12 hours, you compare this to a 21K swim, it's probably going to be around 6.5 hours. So from a pure endurance standpoint, no, this is not the hardest thing I've done. I think psychologically, this might be one of the harder things I do because, with long course Ironman, you're on a bike, then you're in the water first, then you're on a bike, then you're running. So there's lots of variance, there's lots of different distractions when you're in the ocean with just you and a guy in a kayak next to you and nothing but the ocean and, land in the faraway distance. The reality is you kind of have to keep your mind very calm. And that's probably what makes it a more difficult race from a psychology perspective, because there's very little underneath you to distract you. So yeah, you play games in your mind, you do all sorts of fun things just to keep yourself distracted and then motivated and then kind of get yourself to the end point.
Very interesting. I don't want to spend long on this. Just a curious question came up. When you're doing this, are you listening to music while you go at points, or is it all just listen to the water?
No, I think you just have to listen to what's going on in your head, pay attention to what's going on there, and the demons will pop up, of course. They'll pop up at different stages, and you just have to learn to calm them down. And different people use different techniques. I've listened to quite a few long course professionals, and some people use breathing techniques. Some people lean on previous experiences that they've done just to remind themselves, to stay calm and, just get that next 1 kilometer done and the next 1 kilometer, and then all of a sudden the race is done. So it's about finding those coping mechanisms. And we'll talk a little bit about coping mechanisms a little later on when it comes to trading psychology, because it's no different. Okay, coping mechanism is a coping mechanism. And it's important that traders personalize their own coping mechanisms and use them when they need it. That's the purpose of a coping mechanism.
Yeah. far too interesting of a topic to just brush off, but we must. I wish I could dive into that, but this is not the purpose of our call. So we'll move on. But I'll wish you very good luck on that race. That sounds very interesting.
Thank you.
Kind of jumping into this one, I know I encourage everybody. The first time we talked, we had a really good time of being able to drill into more of you and even your background and how you approach the markets. And so if anybody's missing that or wants that, we can obviously reference the first video. One of the topics that you wanted to bring up during this conversation, and that I was very happy to dive into with you, and where we can start, is this the idea of risk management. And as a general idea, I think every trader at some level knows risk management is important. And I think that if we were to bring on maybe 10 traders randomly, I'm sure 7 of those, if not more, would actually have no plan for how they're managing their risk at all. And if they did have some sort of a plan, they would throw it out the window in the heat of the moment, no issue. And so maybe before we dive into it, what are your initial thoughts on why is risk management such a aware thing, but not a topic that's given a lot of respect or that is taken with the severity that it deserves?
I think it stems from on how trading is marketed in essence. It's not, education's never been marketed from the standpoint of, as an approach to managing your risk, go on and be a successful trader. It's marketed from the standpoint of take this strategy and make thousands of dollars in 3 easy steps. So I think that's probably, how trading, unfortunately, has been marketed. And just generally speaking, there isn't really any good risk management education out there. And again, I think where that stems from is that, if you look at prop trading groups traditionally, okay, so we look at the retail market. I mean, that's always been relatively different to prop trading groups. Okay, professional traders, how they've always typically managed risk. And we're talking about, the last 10, 15, 20 years where you'd have prop firms in the city. They never really managed risk from the standpoint of, I need to, use 1% per trade and that equals this position size. That's not how risk is managed. Even today, that's not how risk is managed in prop houses. How risk is managed in a prop house is very simple. You have a risk manager that'll tell you, look, you've got a daily stop. Okay, it'll typically be a discussion. You'll have a risk manager. You'll say, look, you've got $1,000 stop. That's the stop. It's then up to you as a trader to go and allocate that $1,000 how you see fit. Okay, now, very rarely will you see a trader at the start of the day say, well, I'm planning to do 3 trades today, so I'm going to allocate $350 here. No, that's not how professional traders trade. How they typically trade is, in some shape or form, they will have an understanding as to what their best play on the day might be and what is something that they don't mind committing perhaps a lot more risk to. And then they'll have sort of weaker plays where they maybe just chipping around, scalping out, and they're just doing substantially less risk. So risk management is not something that's done from a pure discretionary prop side. It's not something that's well thought out or highly mathematical. No, this is your daily stop, crack on from there. Now, I mean, one thing I do want to kind of mention is that, this idea of, this question of, do you need risk management? Okay, I think that's something that a lot of traders perhaps, again, it's been sort of sledgehammered into traders that you need risk management to be successful, to which I'd answer, it's not necessarily true. And I say that because I've come from the prop background where we weren't taught risk management. What we were taught was, if you lose more than $600 today, I'm going to kick your ass. Okay, I don't want you to lose more than $600 because it's my money. That's how we manage risk. And we would go away and we'd say, okay, well, I kind of need to assess the opportunity scope and allocate my $600 accordingly and do it quite wisely. Now, why I say, this question of do you need risk management is that I think for, let's just come back to the professional traders. What they would typically do, okay, you sometimes see on social media traders having £1 million days, okay? That's all true, okay? It is all true. You also sometimes see traders that take 100K count and they have £1 million day on it. And that is also true, okay? But what's important to understand is that risk management is determined purely off of what are your objectives as a trader. Okay, you have to, before you start working out how you're going to risk and how much you're going to use per trade and all that, you first have to define what are your objectives as a trader. Okay, now, a prop trader that works in a prop house that's backed by someone, more often than not, their objectives are not there to sit there and make $200 a day. They are there to make a career out of trading. They're there to make a life-changing sum of money. So they are looking to make the £1 million day. Now, You cannot make £1 million day without taking significant risk relative to your account balance. Okay. So coming back to that question I asked is, do you need risk management? The short answer is no. What you need ultimately is a set of objectives. And then from there, you need to define what risk management approach you are going to take to align with those objectives. Okay. And so that guy, that trader that wants to have £1 million day, the reality is that he's going to need to be willing to put his account, 40% of it, 50% of it, at risk in order to capture that £1 million a day. Now, I want to come kind of full circle, and I want to ask you, or not ask, I want to kind of pose the question of, is it right to put 40, 50% of an account at risk at any point in time? And again, most of your listeners will say, no, that's completely stupid. That's ridiculous. If you get that wrong, you're going to lose 40% of the account. And I'll share a personal story, and I'll kind of, hopefully people can relate to it. It was 2015. I was out in Cape Town in South Africa, and I was on a really good run. Okay, I was making really good money. And literally, I think it was about 45 seconds before 12:45 ECB rate decision, the Financial Times had announced that the ECB was not going to cut rates, and it was fully priced. And I went 40 lots long euro-dollar FX, and I was about $14,500 up even before the rate decision had been announced. So it was one of my better days of my career. Again, at 12:45, it was confirmed by the wires that the ECB did not cut rates. And so again, I bought another 40 lots. The market volatility stopped out. Everything went white. I couldn't trade. I couldn't execute. And there was an announcement that the ECB cut rates. It was a mistake. It was a correction made by both wires. And I couldn't get out because the market had volatility shot. So I couldn't exit a trade that I was long 40 lots in the euro dollar. Market eventually opened. I wiped out probably 48, 49% of my trading account in 3 minutes, 4 minutes. Now, the question that I kind of want to come back to is that the right thing to do? Is it the right thing to put 40, 50% of your account at risk? The short answer is, if you want to make the £1 million day, you're probably going to have to take that sort of outsized risk. Now, if you are willing to accept that risk, and you're willing to accept that, unfortunately, in your career, sometimes you are going to get it wrong, and sometimes you are going to get unlucky, and sometimes it is going to go the other way. So long as you can accept that the consequences of managing risk in that way do include you potentially rinsing 40% of your account, or even ending your account, then that meets the objectives. Okay, and that is fine as a risk strategy. It's not an ideal risk strategy, and I would definitely not recommend it for anyone that's been trading for less than 4 or 5 years, but it is a form of managing risk. Okay, there's nothing wrong with putting a large chunk of your account at risk if you think the probability of success is very, very high. So what I would sort of stress to the listeners is, don't see risk management as a fixed thing. It's not 1% per trade. It's not, I must risk 2% per day. It's not that fixed. You've got to be a little bit more nimble with it. And what I would recommend, typically, if you're in that first 2 years of your career, a daily stop is somewhere between 2.5% and 5%. Now, why those numbers? Well, most traders' objectives in years 1, 2 would be very similar, which is survive, learn the markets, stick around for long enough. Those are the kind of objectives you should have in year 1 and 2. The idea of making money in year 1 and 2 shouldn't even be at the top of mind. So for most traders, having a 2.5% to 5% daily stop as a percentage of the count will satisfy almost all objectives. And so that's what I preach, to most traders that are inexperienced, that don't really have much positive expectancy. I'd say, don't be going beyond 2.5%. It doesn't make any sense. Okay, learn the game. And at some point in your career, when you've got experience, when you understand the markets, and the market starts to give you a couple of hits, fine. Then expose the account. Then adjust the objectives. Then don't be afraid to put 20% in the account, because you want that £1 million day. So I think that's the important thing to stress, is that risk management isn't a fixed thing. It's not you have to do it this way, you have to do it that way. What you have to do is you have to have some sort of a game plan. And that game plan stems from, what do I want to achieve as a trader? What do I ultimately want to achieve? If I want, a £10 million villa, the reality is I'm not going to do it on a 10K count, risking 1% of the count. It's just not mathematically feasible. So that's kind of hopefully answers that question of, do you need risk management? And the short answer is yes, you do. And you need to align it ultimately to your trading objectives.
Yeah, very interesting topic here. And I think very counter to everything that's, basically on social media in that respect. And I think that a really important takeaway is the idea that you're not saying while you're trying to learn to trade and while you're still working on consistency, you should entertain the ideas of putting, 40% of your account at risk, because you're not in a position to be making those type of decisions, and that's extremely reckless. And just to stress that as a point. Now, what would you say to the overall idea that at the end of the day, the market goes up or down, and regardless of what our edge is, one of those two outcomes are going to happen. And at the end of the day, you could say that every trade is 50-50 in that way. Being in a position where you put that much of your account at risk, I'm sure is a in the moment decision, because you're probably not starting your day off thinking you're going to risk 40%, I would imagine, as a situation. So what would be the counter there of judging that or weighing in that decision of, I actually don't know what's happening next. I do feel good about this one. Is it a matter of, I'm going to be putting this much up because I understand that this has such an outsized potential that if I am right, I'm not going to get one-to-one risk to reward here. Or what kind of goes into that thought process of making such a large commitment on one trade?
The short answer is very little. Okay, no trader would consciously say, oh, I'm going to risk 40% of my account, and if this goes wrong, I'll lose 44% of my account, and then be willing to commit to it. Okay, so it's actually not a conscious decision. It's a subconscious, impulsive decision. Okay, so how it comes about, okay, and this is important to stress.
Yeah.
Most prop traders, okay, they are always over risking relative to their account. Okay, that's important to stress. They're always over risking, and it's because they've got a very profit intensive type objective. So they want to make very decent money out of trading. So they typically will always be putting the account in a situation where it is at risk of losing probably a lot more than what they would like to lose. Okay, but the safeguard prop traders have is we're in front of the screen 12 hours a day. We're executing at the market. When we're entering a trade with the kind of size that should it go wrong, we could lose a large sum of money. But because we're in front of that screen and because we're sort of hovering over that exit button, the reality is what typically happens is we put a large part of the account at risk, but we're exiting before we even realize that risk. Okay, so it's almost like the way to think of it is we're trying to perfect the timing to such a point that, yes, there is that risk that we get hit on the trade, but in reality, because we're almost getting perfect entry and we never really go offside, the risk is there, of course, but it's diminished by the fact that we are sitting in front of it, just ready to get out of the trade at a moment's notice. Now, coming back to what I said, it's not a conscious decision the trader will make. It'll be something typically event-driven. So imagine Mr. Powell decided now, we had a very hot CPI again today. Imagine he just came on the wires now and said, look, guys, I'm going to be real with you. I don't think we're going to be able to cut rates this year. That's a situation where a trader is going to simply impulsively react. They're not going to make a conscious decision of, oh, okay, so if I use 10 lots in the S&P, that's probably going to cost me 5K. No, it's an impulsive decision to go pretty much all in based on the limit you've got, because the price directional bias, or the probability that price goes in the direction that you click, is very, very high. And the perception of risk reward is very asymmetrical. Now, it's by the time I click it, I don't want to think in terms of 10 to 1 or 21. That's not the right way to think about it. In terms of thinking of it, is I can get a lot of size into the market. I can get a really significant position into the market very quickly. I shouldn't go offside at all. And by the time the market is sort of priced in that risk event, I've already captured a significant P&L. At that point, I'm scaling out. So hopefully that answers the question. It's not a conscious decision. And that's why I wanted to stress prop traders don't assess risk in the same way as a typical retail trader, simply because, at the end of the day, we're sitting there, we understand perhaps what are, really good asymmetric opportunities. And what I do want to stress is they're outliers. They're not something that comes up once a week. They're something that perhaps comes up 3-4 times a year. And when they do occur, we just impulsively react to them. And like I said, it can go wrong. Okay, and that's why what I must stress, it can go wrong. It's gone wrong for me once in my career. I can tell you just recently, this was a month ago, one of the biggest front-end trading platforms in futures went down over the CPI data print. Okay, so imagine, and it was a really hot data print as well. Effectively, I know some traders that were 300-400 lots, 500 lots, 1,000 lots positioned, and they cannot get out of that trade. Okay.
Mm.
They have to pick up the phone to the brokerage and say, listen, can you help me out here? Now, what I want to stress is hypothetically, had the market, for whatever reason, had the market gone the opposite direction to the way many traders had executed, there would be a lot of traders looking for a new job, including myself. Okay.
Mm.
But that's the risk we take as traders. And the important thing to stress is that it does go wrong. You can get caught out, but I accept that risk. Okay, because that's my job. I'm a trader. I'm here to speculate. I'm here to take advantage of opportunities. And if it goes wrong and at some point I lose 30, 40, 50% of my account, I accept that risk. So it's just important to stress that is risk management isn't about always playing it safe, but it's also not about being reckless. It's about applying yourself when the probabilities make sense.
Yeah, and a couple really important things I think to stress with what you said there. The idea that these are outlier opportunities. So if you're listening to this and then you're starting to take in 20% losses 2-3 times a week, and you're just, well, I'm doing what Brannigan said. I'm putting money at risk. That's not what he said. And then also, I think this is yeah, it's a very interesting perspective, and the way that you're talking about risk, where I think in general the idea of risk is this thing to be avoided, and at all costs we don't want to put on risk. But at the end of the day, there is no reward without risk, very literally here. And the more risk we assume, at least the higher potential we have for reward. And our job at a very real sense is not to avoid risk, but we want to take on as much risk as we possibly can, when the situations are right. And it's great to hear you talk about this. I actually have some other questions about this, but I'd like to maybe move on to something and then circle back around. Being very different from, let's say, a prop environment where there is a manager there and somebody's not completely on their own, and then being in a retail environment where most people are probably still on the come up, or at least experiencing some levels of consistency. In your mind, let's say that you're dealing with somebody that is a retail trader, they're not in a prop shop. What would your advice be to them if they understand that I don't really have a plan for how I'm managing my risk? You're talking about having an objective. I don't really understand this. I've always worked under the assumption that I should risk 1% and go for 2-to-1 risk to reward. What would you say is, okay, like this is a baseline under thing I would want you to understand about risk. You've potentially already covered that thoroughly. But what would be your, here are the steps, or here are the things I would put in place to build out a risk plan?
Yeah, I think the first thing is a trader has to be really sort of honest with themselves as to where they are in terms of capability. Okay, if you're in your first 2-3 years of trading, I think if you don't have positive expectancy, that's probably the first sort of sign that you should just be on a simulator. Okay, so the step one, I'd say, be on a simulator. It's free. And simply because in your early stages of your career, your goal is to make sure you can survive. That's goal number one. It's not to make money, it's to survive. Because by definition, to become a successful trader, to get to that point where you can put, larger positions on, you have to actually be around and you have to have an account. Okay? If you don't have an account, by definition, even if you're around for the good opportunities, you're not going to make much money because you've got no leverage at your disposal. So step one for, is survive. That's step one, and you can do that by being on a simulator. Step two, once you decide now you want to move into a live environment. Okay, I don't necessarily think you need positive expectancy to be in a live environment, but when you don't have positive expectancy and you want to go live, step one is to make sure that you design your objectives in such a way that you manage risk accordingly. Okay, that means that if you don't have positive expectancy, risk 1% of your account per day. Because you know what? You can't blow up an account if you risk 1% of it. It's simply not possible. Okay. The only way it's possible is if you cannot follow a very baseline, risk management process, then it is possible to blow up a trade. But if you just simply risk 1% per day, you cannot blow up that account, which means, again, you aligning the approach you're taking to trading to surviving until such a stage that you can actually build an account and grow. Now, one of the things I see, and let's move to that sort of step three. Once you've got that positive expectancy, then you need to actually determine, well, what are your goal objectives? Now, I see a lot of traders saying, well, look, I really want to leave my full-time job to become, a trader. And I absolutely admire and respect that. But then you've also got to be honest with yourself to say, well, look, in order for me to leave my job and become a full-time trader, I need to replace my existing salary of, let's say, £50,000 per year. Okay. Now, what that means is you've got to say, well, for this to work objectively, I've got to generate 50,000 in profit a year, plus obviously cost. So let's call it, I've got to generate 75,000 pounds of profit per year. Now, if you've got a $10,000 account, can you get to $75,000 a year? Yes, you can. But guess what? You're going to have to align the risk management strategy to that $75,000. You're going to have to risk at least 5 to 10% of your trading account per day. And so hopefully many traders will take a step back and say, well, whoa, hang on a sec. If I'm risking 10% of the account to satisfy the objective of becoming a trader, it doesn't sound like the odds are really much in my favor. To which I would say, yeah, that's what people don't tell you, unfortunately. To make money as a trader, unfortunately, a $10,000 account is not going, it's not going to work if you need to be making that money immediately. Okay. What you have to do, unfortunately, as a trader in your early career is you've got to build that experience. You've got to build that skill set. You've got to safeguard that capital, get that account from 10K to 20K. Once it's at 20K, it's going to be a hell of a lot easier to go from 20 to 40. Okay. And that's what most people don't understand. We call it the compounding effect. Once you get to 40K, to get to 200K becomes even more simple. Okay. So once you get that little bit of leverage behind your name, then you will be capable of having those 1K, 5K, 10K, 100K days. But you're not going to be able to do it with a 10K account. And that's the problem. People desperately want to make that money on day one. You've got to get that out of your head. You've got to really make sure that you're approaching this objectively, set the objectives correctly, and take it sort of almost 1 year at a time. So I think the key sort of standout point there is if you are looking to transition away from a full-time job into trading, okay, what I don't want to do is discourage you. That's not my role as a mentor for younger traders. I want to encourage you to take a step back and be holistic about it, right? If you're 40 plus and you're used to a lifestyle of a 50K salary, the reality is you got to ask yourself, can you forego that salary for the next 2 years, 3 years, 4 years in order to enable yourself to get to that point where you can actually become a career professional trader? And I think if people are very honest about it, a lot of them will say, well, you know what, I'm actually not sure I'm willing to take that risk. To which I'll respond, well, if you're not willing to take that risk, then you know what to do. Take that 10K savings, get back to work as a real job, go and invest it in, the S&P 500 over the long run. But don't come into trading set up correctly. Don't come in, sort of almost, with a wrong game plan, because the reality is you will just become another statistic. And so, yeah, whenever I do guide traders, that's the first discussion I have with them is, let's take a step back. Why do you want to be a trader? Do you understand what it means to become a trader? Do you understand the sacrifices involved? And if they give me yes answer to all of it, then I say, let's talk about your objectives. What do you want to do? Okay. And then I say, well, this is my account balance. And the next step is, okay, what do you want to achieve with that? Do you want to make 100K this year? Okay. This is what you're going to need to do in order to get to that point. So it's very much just aligning, again, risk management aligns to the objectives of the trader. That's the sort of one of the key takeaways from today's session.
Let's take a quick break from today's episode because I need to ask you a very important question. Have you ever been trading, maybe up against the hard right edge of the screen, and you find yourself maybe coming off of a loss and thinking thoughts like, what is going on? I'm confused. I don't get it. You ever think those kind of thoughts? Of course you have, because you're not using today's video sponsor, Jigsaw Trading. Jigsaw Trading provides institutional grade tools, education, and insights to help traders make better decisions. And it's no secret that the best traders in the world are using order flow, sometimes exclusively, but they're using it at some level. And if you don't understand order flow, and if you don't have the tools to see it, you're just missing an important piece of information. Full stop. Jigsaw Trading is the real deal when it comes to equipping traders with the tools and education to trade like pros. And I'm talking about their award-winning trading platform called Daytrader. This is going to give you elite level order flow analysis, custom charts, automated trading analytics, and it was built based on techniques actually used by institutional traders to give you clarity into market movement. And that's just one part of the package. They also have Journalytics, the most advanced journaling and analytics system that is going to track your progress and help you identify your weaknesses. They also go beyond tools and resources with step-by-step video courses and drills designed by real professionals to shortcut your learning curve dramatically. So, whether you're a seasoned pro or brand new to the screens, Jigsaw Trading is going to have something for you. Oh, And did I forget to mention that they're giving away a free order flow training right now? All you're gonna have to do is click the link below, and it's gonna take you to a free order flow training where you can see what Jigsaw is all about for yourself. A big thank you to Jigsaw for sponsoring this episode. Make sure you check out their free video training. Now let's get back to the episode.
Yeah. So going back to maybe this, some more practical steps here for somebody trying to figure this out for themselves. Would you suggest they're basing their total risk allowance for the day on, let's say, 1% as they're just transitioning to live before they're seeing any kind of results, while they're getting that proof of concept with themselves? Somewhere up to 2 to 5% would be a recommendation, from what I'm understanding, on somebody who has a bit of traction. And there's this pivotal point where you can switch from I'm surviving to now I'm focusing more on thriving, and I'm trusting myself now more to understand where my best opportunities are, and being able to push the needle. Could you talk us through just some advice on what that transition looks like and how to know when you're ready and when you should not be making that step?
Yeah, I think you've actually summarized that quite nicely. I think, look, the best way to look at what the transition point looks like is step one, and I distinctly remember this early in my career: can you cover the costs of trading? That's kind of your first phase as a trader, which is, okay, I've got front end costs, I've got commission costs, I've got license and subscriptions, and that costs me $4,000 a month. Okay, step one, you've got to be capable of making $4,000 a month. That is your first step. If you cannot get beyond that point, what's the point of sort of going or aligning any other objectives? So that's step one. Make sure you can cover those costs. Once you can cover those costs, what it means is that you're making a sufficient amount of money on average over the course of a month to cover the cost, but also perhaps grow the account. So step two is you've got to start growing that account. Okay. One thing I say to traders very often is, in order to become a bigger trader, in order to build an account, in order to actually make really good money out of trading, you have to almost forgo the wage early on in your career. So you have to sort of say to yourself, well, look, I know that trading costs me, let's call it $4,000 a month. Now, I'm not going to pay myself a salary for the next 6 months. I'd rather take that $2,000, leave it in the trading account, because like I said, as that account balance grows, your position sizing grows as a direct relationship to that account balance. Okay, it means that if my account was $10,000 and normally I'd use 2 lots in the S&P 500, now when my account is $20,000, I'm using 4 lots in the S&P 500, which means when my edge is there, when I've got a trade that I understand well, rather than making an average sort of expectancy of $400, now I'm making $800. And that's what the transition looks like. I first need to cover costs. Once I can cover costs, now I need to just make sure I can start building that account, getting that account growth. Once that account growth starts to showcase itself, then it's about building the position sizing to a sort of point where, and you don't need much. Okay, I think if you're trading 3 lots in the S&P 500, you can easily generate $100K a year on 3 lots in the S&P 500. Okay, but at that point, when you're generating $100K a year, you can pay yourself a really good wage. You can also have account growth, and you can still keep increasing your position sizing. And that's sort of the transitions that traders take. The fourth transition, which is something that very few ever get to experience, is where you now have to start really working at taking on bigger position sizes and taking on or putting more of the account at risk on certain trades. That's sort of where you get the real special traders, where they're not afraid to put 1,000 or 2,000 or 3,000 lots into the market, and perhaps put a significant chunk of the account at risk because they're going after bigger objectives, which is they want that 7-figure day. So that's the phase 4, which, again, like I said, I don't want to talk too much about it because I don't have that much experience about that phase 4. I mean, of course, I've tried many a time working at that, and it's an ongoing process. But I've never had a 7-figure day, so I don't know what that process looks like. But by the time I do have it at some point, we can have that discussion again, and I'll tell you what it's like. So yeah, that's what I would say the transitions are like. It is very much break those costs. Once you can get over those costs, keep reinvesting into your trading account. Once you're reinvesting into your trading account, build that position sizing. And then from that point, everything becomes easier. Okay, I know it's really hard in the beginning. It's a very difficult initiation for traders. But if you can get past that phase 1, 2, and 3, it does become a lot easier and more enjoyable.
Yeah. What would your advice be on the position size for each individual trade? Do you think that there's any wisdom in understanding that I'm risking this 5% of my account and I want to give myself 3 chances, so I'm gonna, chunk it down that way? Or do you have a different idea of
Yeah,
what's the better?
the best wisdom I can give you is have some plan. That's the most important thing. Have some plan. If it's something as simplistic as, I'm willing to risk $500 a day of my account, and I want to do 5 trades a day, and you risk 100 on each trade, that's a good plan. That's a solid plan. It's a foolproof plan. You can't fail with a plan like that. And that's the key. Risk management is less about math. It's less about being super intelligent and wise, but it's all about being consistent with it. Okay. So that's the first thing I would stress. The next thing is an example. Okay, how professional prop traders typically think about allocating risk per trade. Think of it as how much am I going to put on this trade idea and that idea. It's what we call the ABC system. Okay, where your A trades are in essence your best trades. They're the trades you have edge on. They're the trades you have a journal with 50 examples of it. They're the trades that you've developed an understanding of what are the key characteristics that define that trade. Those are the trades that effectively, if it comes up and my risk on the day is $500, I don't mind putting 300 or 400 or 500 of my 500 on that trade because I think I've got a high probability of winning. I understand the trade. I understand what it's supposed to do. So I'm going to bet on my horse because I know what my horse is supposed to do. The opposite side of that spectrum is what we call the C trades. Okay, they're the impulsive trades. They're the trades where, this guy on Twitter shared a chart of the cocoa thing, and I want to give it a go because I think it's doing this and it looks interesting. It's the random stuff. It's the rubbish stuff. It's the impulsive stuff. But the reality is we mustn't pretend like we don't do the impulsive stuff. We do it. Okay, it's just we need to safeguard ourselves when we do it. So by C trade, it's something like, well, if I put $25 of my $500 in this trade, if I lose it, so what? Who cares? It's not the end of the world. I get to scratch an itch. And, the worst case scenario is I lose $25. And then the B trades are the in-between ones. There's a little bit of structure. There is understanding, but there's possibly some preemptiveness required. So you preempting the timing on it, but you don't want to wait too long in case you miss good prices. So there's that little bit of uncertainty in terms of the information curve. You still need to wait for a bit more information before that trade comes into play. But those are the B trades, okay, where we don't quite have a full understanding of the opportunity scope. So in order to kind of satisfy taking that trade, we reduce the risk slightly. And that's the way to think about taking, risk is think of it as an ABC. Think of it as my best plays. I want to bet more on that. My shoddy plays, the random stuff with negative expectancy, I don't want to bet much on it, and everything in between, I'm willing to bet, something on it that can make a difference on the day.
Yeah, very great words. And a lot of what you're talking about here and this topic in general, it's really highlighting just the skill portion of what it takes to be a trader, where we don't have these certainty things where these come up and I do this, this, and this, and this, and I get this kind of an outcome. And the ability to know that in this situation, I want to do this, or in this situation, I'm making this move. This is a skill set that nobody can do for you. Nobody can tell you what to do. You have to know what to do with it. And it comes with time, and it comes with experience. And maybe just to go back to the point which you've referenced already, I believe, but the markets are incredibly uncertain. And so as starting off, creating these structures for, okay, I am going to risk this much per trade, and just totally protect myself and be fine. And then earning that ability with yourself to be more discretionary and to make those aggressive decisions when the time is right, is the natural path forward, of course. Could we talk about this a little bit? Well, maybe I should open up actually. If this idea of risk management, I think we've spent quite a time here and you've given such good insights on it. Is there anything left that you think we should still discuss about this before we move on to something?
No, I think the only other thing I would say is as a practical tip, one of the things I really like and I encourage particularly young traders to do is don't be afraid to focus on targets. Don't be afraid to setting yourself targets. Again, you must remember early in your career, there are certain objectives you must achieve. Okay. And like I said, those objectives early in the career is number one, you need to cover your costs every month. Okay. That's how you survive, by covering costs. So to satisfy that objective, guess what? If I can bank $100 today and just sit there and watch it for the rest of the day, right? That's good, smart trading. So don't be afraid to have targets early on in your career. I think targets are a very good way of managing yourself and managing that impulsive nature early in your career. And I even use targets, particularly when I go on a little bit of a bad run. Okay, I actually use targets as a bit of a coping mechanism, simply because, and I mean, we'll talk probably a little bit about psychology later on, but I think one of the things where targets works well. Okay, think of what a bad run is ultimately. You've got a drawdown on the account, okay, and the focus moves away from process and it starts to move towards safeguarding. I'm losing money. That's money that could be in my bank account. I become a little bit fearful. Now, what a target ultimately does is it enables you to move away from, because what you're doing when you set a target, okay, let's say your loss, your drawdown is 20K. Now I say to myself, look, I just want to come in tomorrow and make $1,000. That's not going to dent the loss ultimately. But what it allows me to do is lower the bar, lower the expectation on myself, which means there's no pressure for me to perform tomorrow. Now, when there's no pressure for me to perform, what it means is that I simply have to just come in tomorrow and do probably the simplest little thing. I don't have to chase anything. I don't have to make anything up. I can just sit there all day and go, oh, well, okay, there's my $1,000 and the job is done. Now, the reason why this works is because the emphasis moves away from making back the 20K to just making 1K. And as a result, I'm not focused on making losses back. I'm focused on just find a good trade. So I'm refocusing the mind on process as opposed to outcomes. And that's a really clever way to just cope with a drawdown. It's find a coping mechanism that works well for you. And what typically happens, what you'll find if you do this, and you've experienced it enough times, is the following day, again, come in and set a target. Maybe make it $1,500. Maybe keep it at 1,000. But what you'll typically find is that because you're immediately focusing on process again, you'll find that you'll take a good trade that perhaps goes a little bit further on side than you perhaps anticipated, and you'll make back perhaps 2.5K the next day, almost accidentally. It wasn't part of the expectations. And then suddenly you're now back in that rhythm of focusing on process. And what so often happens is you'll find that drawdown comes back almost within the same month. And that's the trick to getting out of a drawdown, is you got to get the emphasis away from, focusing on the loss, and you got to get the emphasis back on and the mindset back on to getting back into the process that enables you to perform and make money. And yeah, I'm all about coping mechanisms. Okay, you've got to deploy coping mechanisms for everything. We can talk a lot about that later on, but that's one sort of targets are very, very useful for that.
Yeah, beautiful. One of my follow-up question was actually going to be, let's say we take one of these 20-30% drawdowns, and what is the process for dealing with that, and what do you do the day after? And you've answered this already. And very important what you just said, and I hope everybody's listening to this, because I know in trading, I think one of the craziest dynamics is there's something about this space that will literally just take everything from you. And it has a unique way of just being encompassing. And if you're not careful, we have this insane level of importance that can be on any one trade or what happens next or any tick. And this idea of what you just said with that coping, of just removing that importance and changing the game and not getting sucked up into it. This is the only way out. You want to try to get sucked into that game and try to fight your way out. And it, it's disastrous. We've all been there, and nobody survives something like that. So very good words. I'm glad you explained it that way. But now that we are talking about, this would get into the mindset side of trading anyway. As a general rule, would you agree with the fact that trading is 80% mental, 20% tactical?
I don't know how useful a ratio like that is. To be honest, I don't think you need to think of it that way. You're kind of just setting a bias in your head. What I would say from a foundational standpoint, and I've experienced this in trading, I've experienced it in entrepreneurship, I've experienced it in triathlon, which is in the beginning, you sort of start at the base of a pyramid structure. Okay. And in the beginning, your objective as a trader is just to learn as much as you can, absorb as much as you can, get engaged as much as you can, and experience as much as you can. Now, at that point, psychology is just not even relevant at that point. Okay. That's, it's a bit like, someone who wants to, perhaps, I don't know, learn a new sport, and they already want to get into technical details of the sport before they've even actually just got in and seen if they enjoyed the sport. Okay, so it's very much foundational where on day one, you've just got to get stuck in and involved in the markets and in, absorbing what the markets are teaching you. Psychology plays a role very late on in your career. Think year 5, 6, 7, 8, 9, 10. That's when you need to start really digging deep into your own insights, your own understandings. Because remember, a coping mechanism is not something I had on day one of my career. Someone didn't come say to me and say, Brannigan, I've got a good idea for you, by the way. If you go on a bad run, use this target idea. It's great for coping. No, that's not how coping mechanisms work. Coping mechanisms work through iteration. You have enough drawdown experiences and you try and mentally work your way around them and through them in different ways. You try different things. And eventually you find something that, oh, okay, actually that worked. You try it again, you go, oh, that worked again. And you try it again, oh, that works every single time. And it becomes a coping mechanism. So psychology and the mental game, that's something, worry about that in year 6, 7, and 8. Worry about that when you want to start getting 1,000 lots into the market, putting 20% of your account at risk on single trades. That's when you need to start working at the mental aspect of it. Now, I'm not saying that doesn't mean early in your career you mustn't be, working at your game from a standpoint of, looking into your trades you take, looking into how you respond to certain things. Of course, you've got to be doing that. But that's not, when we talk mental game, that's not the mental game. That's just part of trading. You've got to understand why you make the decisions you make, why you got out when you should have stayed in it, and what you can do next time to make sure you stay in it. That's elementary trading. That's not psychology. So yeah, I think this idea of 80-20, I'm not sure that that's really the way to look at it. Rather look at it from a foundational standpoint.
Yeah, very, very good. Under this idea of, let's say, some of the foundational things about trading, like you said, we could touch on the fact that, yeah, this would be something to do with your mindset, because there is a certain mindset you have to have this business. It's competitive, it's uncertain, and if you're too frail up here, of course, you can't ever survive to maybe dive into the deeper things or to ever scale up your account in general. We've already talked about a very normal thing about what to do with dealing with drawdown. And this is a thing everybody faces. And I think we probably maybe talked through this one enough. But maybe we could talk before getting to the place of drawdown, being comfortable with losing. What are your thoughts around this as a concept?
Yeah, I think it's there's a very simple way to think about losing. If you had a $10,000 account and you lost $20 on a trade, I think most traders with a $10,000 account would agree that the loss is relatively meaningless. Okay, and it's meaningless because it doesn't impact the psychology. It's meaningless because there isn't that much of a ripple effect as a result of that $20 amount. Now, if you want to get very comfortable and emotion-free when it comes to losing, there's two things you got to do. Number one, you got to start accepting that trading is not a riskless pursuit. It's not a case of I'm going to make money. It's a case of I'm putting my 10K in account. The probabilities tell me that I'm probably going to lose that 10K, okay, particularly early on in your career. So that's the first thing you need to accept. You need to accept that 10K is in play and it's the 10K that you could lose. And if you're comfortable with that, that's a really good starting point. Okay, if you've got the 10K in the account, you're like, yeah, whatever. If it goes, it goes. It is what it is. That's a good starting point. The second point from there on is you've got to be comfortable putting risk into play on a daily basis. That won't change the way you approach markets. Okay. And how I like to think about this is, again, if you have a really good play, a strategy you really like, and you lost 1% of your account because you took that trade, you're not going to be annoyed by that. Okay. Because it's something you understand. It's something you feel you've got edge, you've got a positive expectancy, a likelihood it's going to go in your direction. And you wouldn't be annoyed with that because you're applying some baseline approach to managing risk. Where traders get uncomfortable and emotional about risk is because, one, they haven't accepted either that the money is always at risk, but two, it's because they always typically over risking. Okay. Now, what happens typically when we over risk is it's not something we intend to do. It's something that happens as a direct result of what we call a compounding bad mistake. So we start off with great intentions. We plan to risk 1% of our account on the trade. And the next thing, we've lost 2.5% on one trade. Now it's 3%. Now it's 4%. That's when we become emotional. We're not emotional losing the 1%. Okay, we're emotional when it gets beyond our control. And at that point now, we have to accept a larger loss than we would have accepted if we're just stuck to the game plan. Okay, and that's where emotions come from. Our emotions stem from the fact that trading is a very uncertain endeavor. There's no control over the outcomes. So by definition, we are all on edge. By definition, we're on edge. We cannot control it. Therefore, as a species, if we can't control something, we are psychologically going to be a little bit emotional and tense. So what we have to do as traders is we have to make sure that we accept the risk or we accept the loss even before we take it. And that's the real key trick here. If you go into every trade, and it's almost like if you go into a trade and the first thing you do is you take a deep breath, you go, am I comfortable with losing $100 taking this breakout trade I've done 100 times? And you just did that. I know it's a very random sort of exercise, but if you just did that every single time, what you'll find is you'll never be emotional taking risk or willing to lose money because you're putting it on trades you understand. You're controlling the things you can control. So that's where emotion comes from. It comes from over-risking, and over-risking typically comes from poor risk management or just a lack of a risk management plan in general.
We all experience times where the market conditions just seem extremely favorable and we almost can't do anything wrong and everything's working well. And inevitably, there are just conditions and streaks of time where the market becomes very unfavorable for us. What is your definition or what is your take and how do you understand when you're coming into a difficult market condition? And what is your approach for dealing with this?
Like now. These have been pretty taxing conditions for the last 2 months. But again, it's a coping mechanism. So I think step one, it's very important because we're discretionary traders. Make sure you got some sort of an indicator that defines difficult conditions. Okay, it can't just be because the 6 guys around me are losing money. That's why it's difficult. That's a little bit of an easy let off. It's got to be something. So I typically use volumes, relative volumes as an indication of markets that are quite locked up. So when markets are really sort of trending very low volume and volatility is particularly low, for me, those are very difficult conditions. Now, I've got 2 choices as a trader. I can keep headbutting the wall, hoping that I'll get through, or I can take a step back, recognize I'm not going to get through, and make the necessary adjustments. Now, again, early on in my career, I'd just keep headbutting the wall, and I'd get the same outcome all the time, which is a deep drawdown, more frustration, more irritation, more drawdown, eventually stop, take a step back, but then I've got a deeper hole to fill ultimately. Now it's very much indicator driven. And when the conditions are difficult, the reality is I've got to scale back. Okay, and scale back means I've got to reduce the position sizing. I've got to reduce the level of activity. And again, I've got to use that target thing where I come in and say to myself, look, sure, I like having a 10 grand day. It's great. That's a lovely target to normally have. But if I can come away making 2 grand today and I can risk slightly less and I can do that maybe 3-4 times over the month, okay, my account hasn't gone anywhere. I'm not exactly paying myself a groundbreaking wage. I'm not exactly, having the best month of my life. But the reality is I'm not making any mistakes. I'm not compounding any errors. So there's got to be that adjustment. Okay, if you don't make that adjustment, if you don't manage those expectations, you're not acting as a professional trader. Okay, what is your job as a professional trader? Your job is to make money. And sometimes your job is to make a lot of money. And sometimes you've got to step back and recognize that the market is just not going to give it to you. It doesn't matter how much you want to force it. And that's the art of a professional trader. It's being willing to take that step back, accept that it's just not there right now, and make the necessary adjustments.
Thank you for explaining that. Euphoria is something that we have to deal with as well. And I think everybody's experience having the best trade of their life, the best day of their life, and a tale as old as time that just leads to an absolute horrific outcome next. What is your ideas or how are you dealing with or your advice for dealing with a really good day or a really great trade?
The first thing I must say is that enjoy the really good up days, the record days. You've earned them. I think early in my career, I remember my first 10K day, and I remember I was over the moon. It was special. I was like, wow, all the years of hard work and sacrifice has culminated into this golden moment. What I will say is the novelty does wear off pretty quickly. But what you misunderstand, and again, this is all about psychology. It's all about understanding how your mind works. When you have a really good day, okay, your psychology naturally alters because you've now got what we call sort of almost a growth spurt. Okay, it's a new normal. Okay, and the problem is what typically happens is there's sort of this pressure valve being released. I've had this really good day. It feels like, okay, I've taken that step forward. But what you misunderstand is that pressure focuses the mind. We need pressure to focus us to make the right decisions on a daily basis. It's crucial. Pressure is what enables us, to keep progressing as traders. So when we have that really big day, the pressure valve is released, and the natural tendency is for you to loosen up on the process, for you to perhaps maybe come in 10 minutes later the next day, for you to perhaps maybe not prepare as well as you typically would, for you to perhaps not debrief, as you would normally the next day, for you to go out for a dinner a little bit later. So there's that natural tendency to make an adjustment to the process. So again, what I typically say to traders, don't forget, when you have those big days, they are not the norm. They are an outlier. Understand that they are an outlier. Accept they're an outlier. Come in the next day and just set yourself a target again. And make sure that that target is a normal target. It's a normal day for you. Because if you can do that, again, think of, I've just had my 10K day. And my typical up day is 1K. If I come in the next day and I don't make the adjustment, what will happen is, in my head, I'm not thinking 1K. In my head, I'm thinking, I'm a bigger trader. I'm a better trader. I'm better than this. And what happens when we think that way? We make an unconscious adjustment to the way we approach the markets. We adjust the process. Okay. And then what typically happens? We lose a little bit. Suddenly we 2K down. Suddenly we're chasing because now I'm giving away some of yesterday's P&L. And the result typically is we give back unnecessarily a lot more than we need to. So the trick after a good day, it's very simple. Take a step back, set yourself a target, lower that bar again, lower that expectation for the next day. And what you'll find again, what happens is that you very quickly come back down to earth, let's say. You come back to normality very quickly. And as a result, you don't need to actually give away, needlessly give away chips. And then you get back into that process of making your £1,000 a day again. And that's the key. It's a little trick that unfortunately took me it took me a long time to learn. I think for many golfers, I used to play a lot of golf. Now, obviously, not so much. But I always remember I used to call it the birdie effect. And it used to annoy the hell out of me. Now, if you don't know what a birdie is, it's kind of where you're shooting 1 under par on a hole. So you're doing a better score than the hole demands, in essence, from you. And what I would always find is I would always go birdie bogey. Always. It was never birdie par. I could never consolidate a birdie. And it's that exact same mental mindset where, think about it, you've just beaten the hole by 1 shot. You've been better than what the hole demanded of you by 1 shot. The instinct on the next hole is you're not 100% focused. You perhaps are a little bit confident. You take an unnecessary risk where, there's water there. I can just go over it. And the result is an error creeps in. You make a mistake. You take a bogey. And it's like, why did I do that? Why didn't I just play to the strengths? Why did I lose that little bit of focus? So yeah, that's the only thing is, again, just making that little adjustment. And what you'll find if you adopt these little coping mechanisms, sure, I get that a lot of traders say, no, man, you have your best up day. You need to come in the next day and push on. That's fine. You do need to push on when that account balance grows, but you don't push on by coming in the next day with unrealistic expectations. You push on by recognizing my account's gone from whatever, 30K to 40K, which means now my position size goes from trading 2 lots in the S&P to trading 3 lots in the S&P. That's the push on. It's got nothing to do with the P&L. It's got nothing to do with my ability to make another 10K day. And it's got everything with me now being in a position where I can use that additional lot. Okay, and that's the real key. It's just take that step back, recognize it for what it is, let that psychology adjust, don't get ahead of yourself, get back to work.
That was a really great segment. Could you talk about this idea of patience in our trading, but maybe more specifically like strategic patience? I think in every job you could ever have, if you're just sitting there doing nothing, you're being bad at your job. And the market gives us unlimited opportunities to be active. Could you talk about dealing with the patience of what we have to do as traders?
Yeah, it's probably an interesting question for me to answer. I'm not naturally patient. I'm actually quite a creative person. So for me to sit down and watch the ladders, it's mind numbing for me. But I think sort of how do you be patient? I think what it comes down to and what I've done for myself over the years is I've tried to create contextual signals. Okay, so I have certain setups or strategic plays or market conditions in which I want to apply myself. For example, okay, we are recording this on the 10th of April. The currencies are finally back in play. Okay. I'm very interested to come in tomorrow morning and be short euro and pound. It's a day two play. It's a strategy that I've seen many, many times in my career. And finally, the context is there for me to do it. Now, when I have those contextual signals going off, I'm not coming in tomorrow going, oh, what can I do today? I'm coming in tomorrow going, okay, there's something for me to do in the euro. Perhaps there's something for me to do in the bond space. And maybe there's something for me to do in gold. And outside of that, sure, if the market brings me into play, if suddenly, we have some escalation in the Middle East and oil starts to prop up and and it brings me into play, fine. Then I'm ready to execute that and I'm ready to move into gear. But by and large, having a structured approach to how you take trades is the key to patience. Okay, it's about making sure that you're not sitting there finding something to do, and what you're doing is instead you're relying on something that's a bit more objective to tell you what you need to be doing. This idea of, you can just be patient and practice your discipline again. I think that's all just, it's not a coping mechanism. You can't just be patient. Okay, you need to actually put something in place that's going to enforce you being patient. It's going to help you to be patient. So yes, I've probably had to take very drastic measures to get to that point. And then the other thing, I think the way to sort of psychologically think about it as well, and there's been a number of times I've done this in my career when markets get a little bit more difficult, is I would typically, I'm not afraid to take a week off from trading. I'm not afraid to walk away from the markets. I'm not afraid to say, look, I don't know what's going on. I'm really battling. I don't care. Even if it's easy for some, I'm not afraid to just walk away and say, I need to get back into the right mindset to be able to, take the opportunity scope. And again, coming back to the golf definition, I laugh about this sometimes, is that in golf, you've got 18 holes and they rank each hole from the easiest to the hardest hole. And the reality is even the easiest hole in golf can be difficult if you're swinging the club bad. Okay? And it's the same in trading. If you're not in the right mental state, it doesn't matter how easy the markets are, it doesn't matter how many hits they're giving you, you will botch them in some shape or form if you're not in the right mental state. So yeah, coming back to, obviously you spoke about patience. Again, I think you've just got to find what works for you, but recognize that when you're impatient, the byproduct of impatience is going to be underperformance by definition. So try and lean on that, try and find a way to enable yourself to be patient, because the drawback of not being patient is, unfortunately, you're underperforming.
Yeah, very well said. Again, you're really absolutely crushing all of these questions and these topics, and your approach of what comes from you is just this absolute raw and real life of what it's like to trade and what it takes to succeed in this as a business. And this has been a very impactful hour. I can't believe it's already been an hour. But I really want to thank you so much for the time and for sharing all that you have. I'll definitely turn it over to you as for the last words before we wrap up. If there's anything you'd like to go off on, or anything you'd like to say as a final word before we say goodbye.
Yeah, look, I think when it comes to risk management, let's go full circle and kind of finish with that. Just recognize where you are in your career. Okay, don't think of risk management as this fixed thing. It's not a fixed thing. It's an art form. Okay, but risk doesn't have to be complicated. It needs to be simple. It needs to be something that you can be consistent with. Okay, and that's the real key to risk management. Like I told you, I gave you the story of the prop traders. Okay, and they've got almost this very weird, over-risking, over-leveraged way of managing risk, but it works because by definition they're making seven-figure years. So that's not wrong. It's not right. It's just one way of managing risk. So make sure step one that you determine what your objectives are. Okay. And step two is then have some sort of a game plan. That's really the key takeaway. If you have some sort of a game plan, you're in a really, really good position to ultimately achieve those objectives. Because what you'll notice, and this is the key, either your objectives are not feasible and they're not realistic, or they are. And you will notice that if you say, I want to make 100K a year, but I got a 10K account, if you're smart enough and you look deep enough, you'll realize whether or not it is a feasible goal or not. And that's the real key. It's just making sure you're thinking a little bit about risk, aligning it to your objectives. And what that'll do is it'll just set you up a little bit better so that you've got a good shot at this. Okay, this is a tough job. Don't make it more difficult for yourself by not getting the elementary easy stuff right.
Great words to end it on.